She left California with a bill of only about $20,000 to $30,000. Then she moved her entire life to Arizona. New state, new address, new everything. She thought she was done. 14 years later, California sent her a nice letter stating, "We've leveraged all of your assets because we believe you owe us $160,000. Because nobody told her she had to formally close her business with the Franchise Tax Board. Not with the Secretary of State, but also and separately with the Franchise Tax Board. It needs to be in writing, and you need to get a confirmation back. California runs entirely separate, two different divisions, and neither one of them know how to talk to each other, which is impressive, honestly, for an organization dealing with your money. One step, 14 years later, and $160,000. If you own a business and you're looking to make a move to Nevada, this video's for you. And the window to structure this correctly is before California's November ballot, not afterwards. Because the general residency stuff anybody can tell you. But the business side of this move is where people genuinely get hurt. And almost nobody covers it with actual details that can be found useful. So that's what we're going to hit today. And if you stick around to the end, I will give you a free copy of our business owner's checklist for relocating. I'm a broker in Nevada and California also. I moved here myself in 2015 and I've run a business on both sides. So this is having the conversation inside and not just strictly with clients. And what I want to walk you through today is the part where most people miss it. And not because they're not paying attention, it's generally because their advisors are not asking the right questions. The checklist for business owners are very different than those of employees. There's more moving parts, more exposure, and more angles that California can keep their grip on what you're doing. So let's go through them. Business owners have different problems. When an employee moves to Nevada, their residency is generally a personal in nature. They have days in the state, their paper trail, and then professional connections, and then they're done. When a business owner moves though, they have basically two different residencies that they have to deal with. Their personal residency and the residency of their entity. And California treats those things independently, which means you can do everything right personally with a new license, new address, and new voter rolls, basically the entire list, and still find yourself in a position where California keeps billing you because your entity was not closed out correctly in the state. Those are two separate fights. Most people are only aware of one of those, and the state of California is happy to let that continue. California has a minimum tax of $800 every single year for any entity that stays active, and that's even if there's zero income. The clock starts ticking on that when the entity's formed and not when you moved. And it keeps running until you formally close it with the Franchise Tax Board and not just the Secretary of State. And there's another piece that really surprises business owners. Even after you move, California can still tax you for the income that was derived in the state. That's not a loophole, and it's not a technicality. It's a particular statute that has decades of enforcement. Most people call it the Jock tax. The term came from professional athletes living in the state. Basically, it looks like every state that they played a game in, that state collected some taxes. California and New York are a couple among some other states also, all taking a cut of their salary for basically playing the game there and not where they live. Same concept, different job title. The legal backbone in California is a Revenue and Tax Code section 17951. It basically states that if the income was sourced in California, then California is going to tax it. Full stop, and regardless of where that athlete lives. This got enforced aggressively starting in the 80s when Hollywood stars started moving out of the state, but kept earning money tied to California with studios, contracts, and productions. California basically looked at that situation and said, nice try. And Section 17951 is how they said it in writing. So when you hear that moving to Nevada eliminates your California income tax, that is true for income you earn in Nevada. It's not true for income that's still sourced to California. Those are two different sentences, and the gap between them is where a lot of business owners get hurt. So the move is not leave California, stop paying California. The move is structure your entity transition and your income sourcing correctly so California's legal claim on your money shrinks as your presence there does also. And the distinction matters a lot if you have a business. And for most people, they figure out that that exists after they made the move. And if you're sitting there wondering if you're the first person doing the math, let me put your mind at ease. You are not. Not even close. Between 2018 and 2021, 352 company headquarters left California. This is including 11 Fortune 1000 companies. In 2021 alone, the pace doubled to 153 locations in a single year. And that's just companies. The IRS migration data, which tracks adjustable gross income moving between the states, shows California lost a net of $102 billion in reported income from the people leaving between 2020 and 2022 alone. In peak years, that number actually jumped all the way up to $24 billion a year leaving. That's not an advocacy number either. That's the IRS. So the people doing this math are not outliners. They are a very large group of people who looked at their tax bill and their options and made the same decision you're considering right now. And here's the part that should make it feel a lot more urgent and not less. California never seems to be done adding to this list. So let's discuss what's on California's ballot for 2026. As of right now, in April of 2026, there are two competing ballot initiatives scheduled for the November election. The first one is something called the Billionaire Tax Plan. It's proposed a one-time 5% wealth tax on individuals or trusts with a global net worth over $1 billion. Now, I get it. You might be hearing that number and going, I don't care, that's not me. And statistically, you're probably right. But here's why this matters to this conversation. California has never passed a wealth tax before. And if this one passes and it's on track for the ballot, it establishes the precedent that net worth itself is a taxable event. Not income, not gains, a simple net worth. The threshold today is $1 billion, but we all know thresholds move. And knowing California, if this passes, we know it will take about 3.5 minutes before that threshold does move to broaden the pool of taxpayers in this. Right now, it's seemingly unrelated to most without that kind of net worth, but it's a test. And if people go along with this and they vote this into law, the next threshold is very likely to end up in the millionaire's lap. But consider what that actually means. Think of home equity, investment accounts, and savings. It's not a stretch to say a lot of people fall into that category. And California has always shown that they have an innate ability to find more and more things to tax to their credit. So with net worth being the next thing on the list, it shouldn't be surprising to anybody who's paying attention. So the current initiative with the Billionaire Tax Act proposed a 5% one-time levy on global net worth above $1 billion. It's all due and payable by 2027. It excludes, currently as it's written, primary real estate, pensions, and some retirement accounts. It also excludes revenue earmarked for Medi-Cal, food assistance, and public education. Currently, it's in signature gathering phase for the November 2026 ballot. But again, keep in mind that this is a test to see if they can get this done, and then we know that Mark always moves and expands from there. But the good news is there's a second initiative that's been filed that is in direct contrast to the first. It's called the Retirement and Personal Savings Protection Act. It was filed by a group of business leaders and taxpayers, filed also as a constitutional amendment. If it passes, it would prohibit California from enacting any new taxes on retirement holdings, individual-owned assets, or personal savings on or after January 1st of 2026. If it passes, it will also ban any retroactive taxes, which is now back in the crosshairs with the 10% exit tax. If you haven't heard about this one proposes taxing everything you have in order to leave the state. We're talking equity, savings accounts, retirement accounts, and any sort of assets that you have that they want their piece just for leaving the state. So if that can get passed, that would directly conflict with the Billionaire Tax Act plan to tax assets that were held as of January 1st, 2026 or later. The initiative on the Retirement and Personal Savings Protection Act is proposing constitutional amendments prohibiting any new California taxes on retirement accounts, individually owned assets, or personal savings on or after January 1st, 2026. It also bans retroactive taxation. It's filed as a direct counter to the Billionaire Tax Act, currently in public review phase for the November 2026 ballot. Both of these are in signature gathering or public review. Neither one is passed, and maybe neither one will, but they're both on the ballot for November, just a few months away. But consider the fact that California is actually actively debating whether tax of a net worth as a category tells you everything you need to know about the direction of travel. This isn't about paranoia. This is about reading the room. The people I talk to about moving to Nevada are not running from a crisis. They're watching the trend line and making rational decisions to get out before they watch that line move again. And for business owners with entities, equity, and deferred comp with pending liquidity events, the window to structure this move correctly is before the November election and not after. So let's have a talk about the checklist. Now, before we talk about dissolving entities, I want to talk about something that trips up S-Corp owners, because the structure of the entity changes how you address it and what you have to do. And if you have an S-Corp, the standard information that you get from most is going to cause you a problem. Something you need to understand is not all business entities dissolve the same way, and the path that you have to take depends on the entity that you actually have. So let's go through the main three. If you have a California LLC, you file articles of dissolution with the Secretary of State. Then you file a final tax return with the Franchise Tax Board. From there, you should get a confirmation that the entity is closed in that order. If you skip the Franchise Tax Board step, the Secretary of State means nothing to them. California runs two separate divisions, and one hand doesn't automatically tell the other. But somehow they're still very aware of your money, though. That part seems to be coordinated just fine. So if you have an S-Corp, this is where it gets a little bit complicated. An S-Corp doesn't just dissolve the same way an LLC does. With that, you have to formally revoke your S-Corp at the federal level and then come back separately and dissolve it at the state. And if you have employees still in California, even one remote employee still working from California, after you move, California can argue that your business still has Nexus there. What is Nexus? Well, it's the legal ability for California to still tax that income. And a single California-based employee is enough to establish it. One person working from their apartment in Burbank answering emails. And California considers that as sufficient foothold to tax your entire business. They seem to be thorough, I'll give them that. So a business has California Nexus if it has an employees working in California, property in California or conducts business activity in California, regardless of where the owner actually lives. One remote employee working from California after the owner moves can preserve Nexus and associate tax obligations. So before you move, that conversation needs to be had and not afterwards. And if you have any remote California employees, you need to either plan to transition them into Nevada or understand what your tax implication is going to be with them. This is not a small issue for tech founders, consultants, or anyone running a distribution team out of California. And now, if you have a C Corp, that is very different again. C Corps have their own dissolution process. They also have their own final return requirements and their own federal tax board confirmation process. But the common thread against all different entities is every single one of them require a particular confirmed close with the franchise tax board. Not assumed, not inferred, but actually confirmed. So your entity dissolution checklist is do all of these in this order. File your articles of dissolution, get a certificate of dissolution with the California Secretary of State. File a final California tax return for the entity, and it needs to be marked as final. Then you'll file a formal dissolution notice with the California Franchise Tax Board separately. Your fourth step is to receive written confirmation from the Franchise Tax Board that the entity is closed. Your fifth step will be setting up the new Nevada entity before the California one closes to avoid any gaps. Then you're going to want to transfer your business operations, your banking, your contracts to the Nevada entity. And then your final step is to update all your vendors, your clients, and the IRS records to the Nevada entity. But I want you to note that S Corps also require revoking the S election at the federal level separate from the state steps. Also note that any California employees must be addressed before the entity closes. If not, the Nexus survives the owner's move. All of these could have a direct impact on any residential or commercial properties that's owned by the company. Now let's talk about the income sourcing trap, otherwise known as the Jock tax. And here's the one thing that nobody tells you clear enough before you make that move. Simply making a move to Nevada does not eliminate your California tax implications. It will eliminate your California tax exposure if your income's derived in Nevada. Those are not the same sentence. Understand that California taxes its income at the source. So if the income originated in California with clients there, contracts there, work performed there, then California is going to claim it. And that's regardless of where you're at or where you live when you file for those invoices. So if you move to Reno in April, but you're still billing 20 clients in California, that income is still going to have a tax implication even though you live in Nevada now. And that's where business owners genuinely get blindsided. They moved, they did everything correctly. Then their CPA hands them a California tax bill in April, and they look like someone who just found out their gym membership was set to auto-renew for the third year. Except in this scenario, the gym membership is 13% of your income, and the gym is now the state. Remember Section 17951, the Jock tax principle I mentioned earlier. This is exactly where it shows up in practice. The rule does not care where you invoice from. It cares about where the work was performed and where the income was originated. Also understand that the income sourcing is not the same for different business types. The income sourcing issue is not the same for every business type. The service business that can serve clients remotely from Nevada has more flexibility than businesses with a California-based contract, owns real estate, or has operations. The goal is to restructure the income so that it's earned in Nevada and not just invoiced from there. The distinction requires a CPA conversation before the move. So the practical version of managing all this is to start shifting your clients and your contractual geographically so that it's all coming and derived in Nevada. So if you could serve your clients from Nevada, great. But if your contracts are tied to a California location, then that needs to change. And if you're going to have a partial year of California sourced income in the year that you move, which most people will, then the timing of when you move really matters. Moving in January is very different than moving in October, and that is going to make a difference on how much taxes you pay in California when you move to Nevada. That conversation's worth having with a qualified CPA before anything is signed, and not after you're in escrow trying to negotiate a closing date. Now let's talk about deferred comp, equity, and timing. This is two more categories that really catch business owners off guard: deferred compensation and equity events. If you have deferred comp that was earned while you were in California and it pays out after the move, California still will tax it. Residency at the time of payout is not the determining factor. Residency when it was earned is. The same logic applies to stock options, RSUs, and other equity compensation that was occurred while you were in California. The gain attributable to your California residency period gets allocated back to California even if you were sitting in Reno when that's exercised. California will follow your equity across state lines with the energy of someone who spotted an unclaimed item on a restaurant bill. Focused, patient, and not leaving until it's resolved. California uses an allocation method for the deferred compensation and equity. The taxable portion is calculated based on the ratio of California workdays during the vesting or earned period to the total workdays. For an example, a 4-year vest where 2 of the years were in California, then roughly 50% of the gain may be California taxable regardless of where you live at the exercise. And for business owners that have a pending liquidity event coming, in reference to a sell, a buyout, or an earnout, the timing of the move relative to the event can significantly change the tax outcome. Moving before a sale closes is very different from moving afterwards, and the difference can be measured in hundreds of thousands of dollars. This is one of those places where a conversation with the right CPA before the deal is structured is worth considerably more than the cost of the conversation. So everything I've covered so far has been around the business entity or the income. But there's a completely separate place where a lot of these deals really do fall apart, and it happens in the real estate sale transaction in and of itself. And it's a part where most agents don't even think about it till after it's already a problem, especially on the impacts of how commercial real estate is handled. A couple of years ago, I got a call from a business owner who had already made the move. He had already bought a house here and he already had a Nevada driver's license. In his mind, the hard part was already done. And he called because his California CPA actually flagged something. In this scenario, this particular client had used a separate agent for the California side of the transactions. And that agent had structured the close in a way that recognized the full gain in the tax year the house was sold, which happened to be the same year that he moved to Nevada. The agent's not malicious, he was simply thinking about selling that house, which was his job. The problem is for that buyer is selling that house was literally only 1/3 of the job, and the problem with it was timing. The California sale closed after the Nevada move date, but that escrow was structured as if none of that mattered. Here's what should have happened. The close date, the gain recognition, and his move date should have been sequenced so that much of the taxable event as possible occurred while he was a Nevada resident. It's not catastrophic, but it's nothing small either. It was completely avoidable. And that's the conversation that my business partner and wife, Cindy, is built for. Cindy has 20 years of title and escrow experience and an additional 14 years of lending experience to go along with my 22 years in the industry. What that combination means to you practically is when we sit down with the business owner who's planning this move, we're not just looking at whether the house makes sense in Reno. We're looking at how the California sale needs to be structured, when the close date should fall relative to the move, and how all of this interacts with the business entity and timelines. Most agents are thinking about one transaction, and we're thinking about the full sequence. This is why hiring the right team with decades of experience matters way more than just a sell or a purchase. Because for a business owner, this isn't just one transaction. This is actually 3 to 4 that all affect the next decision. And if they're not sequenced correctly, then it creates a problem that the next step cannot fix. The first tax year after the move is the most complex filing that you're going to have to do. I don't say that to scare you. I say that because for those that think that this is going to be so simple are the same ones who end up calling me in March going, "What happened?" On the personal side, a part-year resident return in California for the months that you were there. Nevada personal returns, nothing. We don't have any state income tax. You just need to clarify that with the IRS. On the business side, the final California entity return needs to be marked final with the correct close date. Then the new Nevada entity returns starting from the date of formation here. And this is where the complexity lives. Because if your business in California had sourced income even after you moved, then that income still gets allocated back to California on that final return. If you had payroll running in California during the move year, even if it was just for a few months after you moved, that creates both a payroll tax and a Nexus question that needs to be resolved on that final filing. And if you had any California commercial property, residential properties, equipment, office space, or inventory, then how and when that was transferred to the Nevada entity affects the final California return. None of this is impossible to navigate, but it does require a CPA who's used to filing multi-state returns year after year. Not somebody who understands the concept of what's going on, but somebody who has the actual experience and has done this for several years. They know where the traps are and how to avoid them. So we're going to highly recommend that you get together with your attorney and your CPA and have those conversations months before you make the final move, or even possibly the year before if possible. So back to the woman that I talked about at the beginning of this video, you know, the one that had the $20,000 or $30,000 bill when she left, and then 14 years later got that nice letter stating, "Hey, you owe us $160,000. You now know exactly what she missed. It's not a complicated scenario. She didn't do anything wrong. She simply moved and she had a new address. She even built her whole life in a new state. What she didn't know that California's clock on her entity kept running the entire time she was gone. $800 a year, 14 years later, here's your penalties and interest. And California doesn't charge late fees like your landlord does. They charge them the same way compounding interest does. Quietly, consistently, and for a very long time. It could end up equaling $160,000. All for a step that she didn't even know existed. And that's the part that nobody talks about because it's not that dramatic until it's very dramatic. But the good news is everything I covered today is very manageable. The entity dissolution, the income sourcing, and the escrow timing. all coupled with the first-year filing sequence. None of this is complicated when you know what you're looking for. The only version of this that gets expensive is the version of what you didn't know until after you made the move. So if you're a California business owner and you're considering making this move to anywhere in Nevada, or if you're even partway through this and something I said today landed, here's what the first conversation will look like. We'll go through your entire entity structure. We look at your California income sources and how that will change, if it will, after the move. We'll talk about the transaction sequence when the California sale closes with both residential and commercial properties, and your Nevada buy closes and how all these dates will interact with your move date. We'll connect with your CPA for the filing side so everything's coordinated and not handled in 3 separate silos. That conversation's free and it only takes about an hour, so it'll be a lot cheaper than what you figured out that you missed in February. Our contact info and link is down below in the description. And if you found this video useful, hit subscribe. I put videos like this out every single week to help those people who are thinking about making such a significant move. No padding and no obvious information, just the stuff that really makes a difference. And as promised, just message below the business owner's moving checklist and I'll get it right over to you. I'm Raynor, your go-to realtor for all things Reno. We'll see you on the next one.